ChargePoint has been one of the more disappointing stocks in the market in the previous 24 and 36 months. The company's strategy counted on a rapidly growing EV market that seemed optimistic, to put it nicely. Now, it's trying its best to cut costs and shrink the business to match the reality of a significantly smaller EV market compared to what it was forecasting. In the US, only about 5 out of 100 new cars sold are EVs. Only 5 out of 100. And that's despite an abundance of new models and a flurry of government incentives trying to encourage people to buy EVs. It's just the customer value proposition for EVs is poor when compared to nearly every other option like internal combustion engine, hybrid, or even against shared rides and public transportation. Unless there is a significant improvement in EV technology that lowers prices for customers, things are unlikely to improve. So where does that leave ChargePoint stock investors? Should you buy, hold, or sell ChargePoint stock? I'll answer that question in this video, so let's take a look at the details. I want to thank the Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now. So just as I mentioned in the beginning of the video, ChargePoint stock has disappointed investors. It's down 94% off its highs and in the last 3 years. That's a huge disappointment from investors that were expecting big things from ChargePoint stock. Now, I've told investors to avoid ChargePoint stock for as long as I've been following it now, several years. I last updated this sell rating on ChargePoint stock on June 7th, 2024, and I reiterated and reminded investors, this is not a buying opportunity. Avoid this stock, sell it if you have it. I don't like this company's prospects. So let's update this recommendation. Let's take a look at the progress the company has made in recent months to see if it's lifting itself out of this mess. Now, on September 4th, 2024, ChargePoint updated investors with its recent results. The management team saying that they have implemented an action plan to create efficiencies while reducing operating expenses, and their focus on delivering new software and hardware solutions to make it easier to go electric remains unchanged. So that's the strategy that they're focusing on, and given their business model, given their business, they have no choice but to stick with this strategy and just go at it on a much smaller scale than they were initially planning. The problem is, can this company ever be profitable on that much smaller scale? That's what remains to be seen. Now, revenues are still falling. Second quarter revenue came in at $109 million. That was down 28% from the same quarter last year. This is supposed to be a growth company in a growth industry, but it's declining meaningfully and shrinking meaningfully. That's not good news for investors. One thing that was good is the company's able to lower their operating expenses. That was down 29% year over year to $88 million. And the bottom line of losses of $69 million was down from losses of $125 million in the same quarter last year. So as I mentioned in the introduction, the company is trying to shrink itself to a more sustainable level, reducing those losses on the bottom line, but they cannot do this to reach profitability. The company's unit economics are not in favor of shrinking itself into profitability. What they can do by shrinking itself is to buy more time. If they reduce these losses on the bottom line, they give themselves more time for industry to improve, for developments in technology to improve, for some outside factor to improve, to help the company grow itself back to sustainable footing, to grow itself to a scale where it can be profitable on the bottom line, where it can stop bleeding cash every quarter. Now, the good news is the company does have time. As of July 31st, they had $244 million in cash and $150 million in credit. So that's roughly $400 million of cash. And they lost 69, let's say 70 million in the latest quarter. So that gives them about 5 quarters of runway at this latest burn rate. but that's net loss. That's not cash outflow. It would be more precise to look at cash outflow, which I will show you a little bit later. So ChargePoint announcing another cost-cutting plan. This must be the fourth one since I've been following this company. They announced the reorganization of its operations to reduce their workforce by another 15%. And these cost-cutting efforts are expected to cost the company or allow the company savings of between $41 and $38 million. So that would be another significant improvement in the cost structure. Now, it remains to be seen how much the company's revenues are impacted by these cost cuts. ChargePoint has slashed spending on research and development, and that's going to reduce the innovation, and they're going to fall behind competitors that are launching newer and better EV charging technology. So with the revenue already falling and them losing competitive position, reducing spending in research and development even further is going to put the company even more behind. But what can they do? What can they do? They have limited options to grow the business. They have limited cash on the balance sheet, and they're having difficulty raising money from investors, from lenders that are charging very high interest rates to the company if they want to borrow. So this is one of the only options ChargePoint has at its disposal. So you could see here spending on research and development is down $36.5 million in the most recent 3 months, down from $59.6 million in the same time the prior year. And in the first 6 months of the year, spending is down to $72 million, down from $109 million. But what can they do? Like I mentioned, they can't do much. And they're diluting shareholders significantly. They now have 427 million shares outstanding. That's up from 355 million shares outstanding in the same time last year. So they are unable to generate cash flow to operate the business. So what they're doing instead is going to investors and saying, give us more money so that we can stay in business to buy us more time. Another troubling factor is inventories keep rising, even though the company's revenue is declining. And this is a scenario where you don't like to see inventory rising. In some cases, when a company's in growth mode and they see significant demand ahead, you like to see an inventory increase because that means they're anticipating an increase in demand. That's not the case with ChargePoint. Inventories are increasing because they are unable to sell their products, and they have existing contract with suppliers that forces them to continue building inventory while demand continues falling. Inventory is up to 228 million, up from 198 million in January. I mentioned the cash outflow in the last 6 months. The company burned through $114 million in cash. That was better than the $190 million it burned through in the same 6 months in 2023. And that caused the company's cash position to fall to $243 million. So 6 months, $113 million, let's say roughly $20 million per month going out. And with $243 million, they have more than 12 months to get themselves into a better position, to shrink their losses, to give themselves more time. So with these decreases in stock price, ChargePoint is selling at a forward price to sales of 0.944, the cheapest this stock has been in the last year. Still, I don't think that's a buying opportunity. As I showed with you, all of the metrics in the company are not good, and they're trying to put themselves in a better position. But the problem is the industry, the business model, that was the premise of that business, the premise of the industry forecast. That was all wrong to begin with. And now they're in urgency mode trying to recover. It does not bode well for investors. So I'm reiterating my recommendation as a sell. I will be avoiding ChargePoint stock until there is some significant improvement in the EV industry. Before I let you go, let me tell you about the greatest deal on YouTube. With just a click of a button, you can get free financial analysis from a professor with decades of investing experience. So what are you waiting for? Hit that subscribe button, and I'll see you again soon.